Dear viewers, welcome to our channel Bank Academy. Today I am going to discuss about CAIIB, Bank Financial Management, Memory Recalled Questions, Part 4. Already we had uploaded 3 parts up to 80 questions. Today I am going to discuss 81 to 100 questions, 20 questions. Ripple effect. Ripple effect. It is a systemic risk in the system. Systemic risk is the risk that a default of one financial institution will create a ripple cumulative effect that leads to a default by the financial institutions. So ripple effect means systemic risk. So one organization fails to lead to on other organizations. That is called ripple effect, cumulative effect. In the system risk, one organization facing a risk that is going to be cumulatively affected the other organizations also. That is called ripple effect. It is a systemic risk. Question number 82, country risk. Country risk is a part of credit risk. Country risk means it is a part of credit risk. Credit risk means default risk, NPA risk or non-repayment risk or downgradation in credit rating. Credit rating of the borrower accounts downward migration, that is also part of credit risk. So finally, country risk means credit risk. That is question number 82. Question number 83, where? Very important for BFM exam. Value at risk, VAR. Value at risk is a statistical measure to capture market risk in treasury. Value at risk talks about the risk in treasury. Mostly the treasury is facing market risk. Market risk means fluctuations in currency prices, fluctuations in rate of interest, fluctuation in investment prices. So it will capture the market risk. Now the value at risk explains the probable loss in a portfolio of the bank. Probable loss in a portfolio of the bank within a time horizon. It may be 1 month or 7 days, 10 days or 1 year, 100 days, 200 days. Time horizon. Within a time horizon, what is the probable loss in a bank's portfolio of investment at a given confidence level? So by taking a given confidence level, the confidence level may be 99%, 99% only we are taking at a confidence level of 99 or 98% level under normal market conditions. The value at risk always explains the probable loss under normal market conditions. Value at risk explains at a given confidence level also we have to take. And for time origin is also important. What is the time origin? We are calculating the value at risk. So value at risk finally it will talks about the market risk in treasury. It will explain what is the probable loss in an entire portfolio of the bank within a time horizon, time period at a given confidence level under normal market condition. Very important value at risk. 84. SLR securities. Bank has to maintain SLR against demand and time liabilities. Of presently SLR is 18% of NDTL, net demand. And out of that, the SLR securities bank has to maintain in the form of cash in hand, cash with RBI in excess of CRR balances, cash balance with other banks. This is about the cash balance. Gold, if any bank is maintaining gold, that is also sovereign gold bonds. If any bank is invested in sovereign gold bond, that also. Gold monetary scheme bonds which the bank is having, that also. And SLR securities, state government and central government securities. And securities acquired from RBI under LAF reverse repo. Securities acquired under LAF reverse repo from RBI all will comes under part of SLR securities. This present SLR is 18% of banks net and demand time liabilities that you have to maintain. In this form, bank has to maintain SLR securities. This is question number 84. Question number 85, FCNRB deposits. Banks are accepting the FCNR deposits. What are the conditions? Now, banks can accept the FCNR deposits from NRIs and person of Indian origin. And This is a foreign currency deposit. It is in foreign currency. All convertible foreign currencies we can open the account. It is only in time deposit. FCNRB means only in time deposit. The FCNR time deposit period is 1 year and maximum 5 years. Minimum 1, maximum 5 years. Rate of interest on these deposits, 1 year or less than 3 years period is there. LIBOR or any other swap rate plus 200 basis points. LIBOR plus 200 basis points. 1 to less than 3 years. 3 to 5 years, LIBOR plus 300 basis points. So this is very important question. Whenever any bank is accepting foreign currency non-resident deposits, that is only in time deposits. Minimum 1 year deposit and maximum up to 5 years. Present rate of interest is 1 to less than 3 years. Rate of interest is LIBOR or any other swap plus 200 basis points. 3 to 5 years FCNR deposit, LIBOR plus 300 basis points. This is about the FCNRB only in the form of time deposit. Minimum 1 year and maximum 5 years. This is very easy question, but correspondent banking. What is meant by correspondent banking? We are having, Indian banks are doing worldwide business without any branch network abroad. That is called correspondent banking. Correspondent banking system allows banks to take advantage of the business opportunities in other countries, world countries, without a branch network in that countries. So, Indian banks are doing tie-up with world banks, other country banks, and they are doing maximum business with minimum operational costs. Minimum operational costs. Correspondent banking eliminates the need to have a global network branches. So by opening an Nostro account with worldwide, we can do the business. That is called correspondent banking. In the correspondent banking, the relationship between the Indian bank and the correspondent bank branch is agent. Correspondent bank is acting as agent of the Indian banks. For that agency services, they will take some minimum operating expenditure. So without opening the branch, Indian banks are doing worldwide business with minimum operational costs. That is correspondent banking. For that, we are opening Nostro accounts with that branches for all the collection payments. That forward contract or forward exchange contract definition. Forward contract or forward exchange contract or forward contract. What is the definition? Very important in the BFM. It is a firm contract, a contract which was entered by the two parties, a firm contract between a bank and its customer. A contract which was entered by the bank with its customers for purchase of foreign currency and for sale of foreign currency, specified quantity, foreign currency for specified quantity. On the date of entering into the contract, we are deciding how much is the amount of the contract. And quantity, amount of foreign currency and rate of foreign exchange. At what rate we are going to exchange the contract, that is also said. And what rate we are going to exchange, and what date. What date, what rate, and what is the amount of quantity. Today, at the time of entering into the forward contract, the banker and the customer both are entering into the contract. That is a forward exchange contract or forward contract. This is one of the most useful derivative product for the Indian banks and customers for foreign exchange risk mitigation. This forward exchange contract or forward contract is a non-exchange traded product. The disadvantage is this is not going to be traded in a exchange. This is a non-exchange traded. It is a bank and its customer. So exchange role is not there. That's why forward contract is a non-exchange traded. This question also they are asking in the definition of foreign exchange contract, whether the forward contract, foreign exchange contract traded in the stock exchange or not. No. RTGS plus 88. RTGS plus means it is a German hybrid clearing system. It is a German hybrid clearing system operating as an European-oriented real-time gross settlement system. Operated by European-oriented countries. In the RTGS system, RTGS plus in European countries, they are opening real-time RTGS, gross settlement system. The European countries are operating this, that is nickname is called RTGS plus. Which country is operating? European countries for real-time gross settlement. Marginal standing facility. This is a part of LIF, liquidity adjustment facility of RBI monetary policy rates. Under this marginal standing facility, banks are allowed to borrow from RBI for their emergency or intraday liquidity management purpose. Under this tool, banks are allowed to borrow from RBI for overnight purpose. Period also overnight. How much banks are allowed to borrow? 3% of its NDTL, net demand and time liabilities, up to 39/2021. Earlier that is 2%. Because of these COVID conditions, they had increased to 3% of net demand and time liability. This is a overnight borrowing. This is a overnight borrowing. 3% we can borrow. For this borrowing, bank has to give SLR securities. Normally, the window timing opens in the evening timing. This timing, from time to time, RBI will announce. Presently, up to midnight, banks are allowed to borrow under MSF, marginal standing facility. Presently, the marginal standing facility borrowing rate from RBI is 4.25, that is the bank rate. MSF borrowing rate is 4.25% overnight purpose. Now, 90 rate sensitive assets and rate sensitive liabilities. This is bank's balance sheet management. Many of the times they are asking these questions. What is meant by rate sensitive assets or rate sensitive liabilities in the bank's balance sheet? An asset in the bank's balance sheet or a liability in the bank balance sheet is termed as interest rate sensitive when the interest rate resets on assets or liability, when the interest rate reprices on assets or liability, and the interest rate assets or liabilities revalued as interest rate changes in the market, as interest rate changes by the bank, as MCLR changes by the bank, or the external benchmark rate is going to be changed by the bank. At that time, they are going to reprice the assets or liabilities. That is called rate sensitive assets and rate sensitive liabilities. That is the definition for this. Under AMA, advanced measurement approach. This is the operation risk measurement methods are three methods are there. One is basic indicator approach. Second one is standardized approach. Third one is advanced measurement approach. The advanced measurement approach is very important for examination purpose BFM. Under advanced measurement approach, estimated level of operation risk, how the bank is calculating, that is the question. Estimated level of operational risk, this is the internal. Advanced measurement means internal measurement, internal calculation of the operational risk. Now the bank has to calculate estimated probability of occurrence. So what is the chances of occurrence of that event? That is estimated probability of occurrence of the event. And when that event taken place, what is the impact on the bank financial parameters? If any event has been taken place, what is the impact on the financial impact? Financial loss, number 2. Number 3, what is the impact on internal control? Because of that probability of occurrence, whether it is going to dampen the internal control mechanism in that bank or not. That's it. So these are the 3 parameters under advanced measurement approach banks are taking. One is estimated probability of occurrence, estimated potential financial impact, estimated impact of internal control. 92. Risk management control steps. Risk management control steps. Risk management framework in any organization covering the following. Risk management control के लिए they have to select a framework. What are the parameters and the framework? Organization for risk management. Each and every organization, they have to set up one organization in that risk management. In that bank also, risk management department is there. That is called organization. First, they have to identify what are the risks are there in the banking industry. First, they have to identify the risks in their banking. Then afterwards, measurement. After identification, how the risk is going to be measured in terms of quantification. measurement, risk measurement, what is the level, then pricing, then you have to convert into what is the loss because of that risk, what is the loss, otherwise what further capital required, what is going to be lost to the bank. So that they have to do pricing in terms of monetary policy, monetary rating. And risk monitoring, who will monitor? Risk management committee, risk management department, and control. And finally, risk mitigation. What is the object of risk management? By taking these all the policies, risk identification, risk measurement, risk pricing, risk monitoring, risk mitigation. By taking these steps, how the risk is going to be mitigated, reduced, control in the organization, that is called risk mitigation. Control means overall the risk management object is you have to control, you have to mitigate the risk in that. Stress testing definition. Stress testing is commonly described as the evolution of stress testing. In the banking, we are conducting stress testing. Stress testing means by taking adverse features, suppose increasing NPA, otherwise increase in rate of interest on deposit by 1%, or decrease in rate of interest 0.5% on advances. So these are called the stress testing is commonly described as the evolution of bank's financial position. By taking the negative factors into consideration, we are evaluating the financial position under a severe but plausible scenario to assist in decision making within the bank. So by taking the adverse kind of features, assumptions, we are going to calculate the impact on financial position of the bank. What is the, if NPA is going on increasing, what is the impact on bank quality of assets? What is the impact on net profitability? What is the impact on quality of assets? What is the impact on liquidity? These are the negative points. NPA increase, it enables a bank in forward-looking process. Why we are calculating stress testing? For taking suitable remedial steps as a part of forward-looking assessment. Banks are the going concern concept. So as a part of going concern and forward-looking assessment of risk, which overcome the limitations of statistical risk, measures or models based mainly on historical data. So in one word, stress testing means by taking into negative parameters into consideration, we are calculating forward-looking assessment. Next quarter may anything goes wrong, what is the impact? That is called forward-looking assessment. If 1% reduction on advances rate of interest, what is the impact on next quarter profitability? If there is a 2% increase in NPA during the next quarter, what is the impact? That is called stress testing definition. ECGC functions. Export Credit Guarantee Corporation. It is also Government of India undertaking. What is the functions, objects of ECGC? To encourage, facilitate globalization of India trade. Means Indian exporters, they have to participate in global trade. For that, ECGC is taking steps to assist Indian exporters in managing their credit risk. So, ECGC exporting the credit guarantee cover, ECGC, to mitigate, to manage their credit risk, default risk, as by providing timely information. So, worldwide timely information, ECGC providing to our exporters. That's why our exporters are managing. Credit risk means default risk, they are managing. In addition to that, ECGC is also extending guarantee cover for export related advances. That is also there. To protect the Indian exporters against any unforeseen losses in export business. To protect the Indian exporters against unforeseen losses in their business. That is called. These are the major three functions are to encourage, facilitate globalization of India trade, to assist Indian exporters in managing their credit risk by providing timely information to protect the Indian exporters. LCR, question number 95, LCR, liquidity coverage ratio, calculation by significant currency. What is meant by calculation of liquidity coverage ratio by currency wise? Now, what is by currency wise or a significant currency? A currency is considered called as a significant currency if the aggregate liabilities of the bank denominated in that currency amount to 5% or more of the bank's total liabilities. If any bank having a liability in a particular currency, if that particular currency liability is at least 5% or more of the total bank liabilities means deposits, at that time that bank has to maintain liquidity coverage ratio in that currency also. What is meant by liquidity coverage ratio? High quality liquid assets divided by net outflows during the next 30 calendar days. So for this currency, what type of liquid assets you are having for payment of this significant currency, and what is the payment from 1 to next 30 days of this particular currency. So finally, LCR significant currency means if any bank having a liability in their balance sheet 5% or more than the bank's total liabilities in a single currency, that is called a single currency, significant currency. For that significant currency, bank has to calculate liquidity coverage ratio separately also. Now, 96 treasury products, very important for all the. Now, treasury products are divided into foreign exchange market. In the foreign exchange market, settlement cash, same day settlement, term tomorrow, spot T+2, forward beyond T+2 settlement. This is foreign exchange products in treasury. Money market. Treasury also dealing with money market. Money market means 1 day to 1 year transactions. Call money overnight, notice money 2 to 14 days, term money 15 days to 1 year, repo borrowing from RBI, reverse repo parking of excess liquidity with RBI, that is called reverse repo. All will comes under money market products. Then securities market products. Security means Government of India securities, corporate securities, SLR securities, non-SLR securities is equal to securities market. Here invest in Government of India securities, that is SLR. Non-SLR means private company, corporate securities, bonds, debentures, all will come under this. That is called treasury products, securities. Last point is domestic and global market also. Globally also, treasury has to deal ADR, American Depository Shares, Global Depository Shares, ECB, external commercial borrowing arrangements, trade credit arrangements, all has to be seen by treasury. So, treasury, four types of product. One is foreign currency, foreign exchange. Number two, money market related. Number three, security market related. Number four, global market related. Treasury had to do these four. Okay. Liquidity risk. Liquidity risk means categories of liquidity risk. Liquidity risk means unable to meet the payment obligations. Unable to meet the payment obligation is called liquidity. If a bank is unable to meet its payment obligations of mature deposits, the bank is under liquidity risk. Liquidity risk are again classified into funding risks. Unanticipated withdrawal. So withdrawals are very high. Bank is not anticipating this much of withdrawal. That is called funding risk. Bank is going to unable to get the funding. Customers are not doing the renewal of the deposits. Mature deposits they are not doing renewal. Time risk. Non-receipt of. Now bank is expecting some recovery in the borrower account. Today the bank is expecting some recovery, but that is not coming because of the account turned to NPA. That is called time risk. Now we are expecting recovery in borrower accounts. That recovery is not coming. That is called time risk. Non-receipt of expected inflows in the borrower accounts. That is time risk. Then call risk. Contingent liabilities, crystallization. Contingent liabilities are going to be converted from non-fund based liabilities to fund based liabilities because LC devolved, bank guarantee invocation taken place. Immediately, bank has to make the payment. So that is also called. This is crystallization of contingent liability. 98. In which of the ratio calculation of off balance sheet and on balance sheet items are considered? This is a very important and very critical question. In which ratio means CRAR, capital to risk weighted assets ratio we are calculating. Capital to risk weighted assets ratio we are taking on balance sheet and on balance sheet. On balance sheet means fund based advances. Off balance sheet means non fund based advances. Both we are taking in calculation of CRAR, capital to risk weighted assets ratio. CRAR formula: capital funds, bank's capital funds by total risk weighted assets into 100. Bank capital. Now capital funds is equal to common equity tier 1 capital, additional tier 1 capital and tier 2 capital. This is called capital funds. Risk weighted assets. So bank is calculating the risk weighted assets for credit risk. Fund based advances as for risk weights. Non fund based advances also for calculation of risk weighted. Banks are converting from non fund based advances to fund based advances by applying the credit conversion factor. RBI has given credit conversion factor each and every non-banking this non-fund based limits. By applying the respective credit conversion factors, we are converting all the non-fund based advances to fund based advances by applying the credit conversion factor. Now, this is risk weighted assets for credit risk means advances, market risk investments, operational risk. Operational risk means system failure, frauds, human frauds, non-compliances. For that also you have to take up. So that's why this question answer is which ratio taking consideration of off balance sheet, on balance sheet CRA. Definition of call money: borrowing or lending in unsecured funds, overnight base. Borrowing or lending overnight. Notice money. Borrowing or lending for a tenor up to 1 day, 2 to 14 days. 1 day overnight call money, notice money 2 to 14 days. 2 to 14 days. Term money 15, exceeding 15 days to 1 year. Term money 15 days to 1 year. So call money overnight, notice money 2 to 14 days, term money 15 days to 1 year. This is the definition of call money overnight, notice money 2 to 14 days, term money 15 days to 1 year. It's part of money market. Call money, notice money, term money, part of money market only. Regulate money market regulatories RBI. Now, this is 100 question. Say in the banks, savings bank deposits, current deposits may be classified into volatile and core portions in ALM buckets. At the time of distribution of the savings banks deposits, current deposits in the ALM, as per RBI guidelines, while parking in the ALM buckets, structural equity ALM buckets, asset liability management, savings banks 10%, current deposits 15% of the deposits are generally withdrawable on demand. So 10% normally they are withdrawing on demand, 15% they are withdrawing on demand. So these savings bank 10%, current deposit 15%, we are parking in 1 to 14 days time bucket in ALM. 1 to 14 days bucket. The core portion means permanent portion means remaining 90% of savings deposits, remaining 85% of current deposits may be placed in over 1 to 3 years bucket. At the time of parking of the deposits in ALM buckets, what are the guidelines of RBI recording savings bank? 10% of the portion 1 to 14 days bucket, remaining 90% 1 to 3 years bucket. And current deposits 15% is 1 to 14 days bucket, remaining 85% in 1 to 3 years bucket. This is the a little bit difficult question but important for ALM management. Dear viewers, these are the presentation of these 20 questions in this part 4. Thank you very much for all for extending your support to our channel. Thank you very much.